Welcome to another episode of Good Value by Antipodes.
In today's episode, I'm joined by Antipodes Portfolio Manager James Rodda, who has spent 2 weeks on the road attending 3 bellwether conferences across the US covering tech, media and telcos, and consumer. Given the recent price action in global equities, with mega-cap tech stocks now down 16% this year in US dollar terms at the time we're recording, and some weaker consumer data coming out of the US, there's no better time to get a temperature check on the trends driving the tech sector and the health of the US consumer. James, welcome back to the podcast.
Thanks for having me again, Alison.
Let's start with the tech conference. What are your key big picture takeaways from the conference and the trends shaping the sector?
Yeah, sure. Look, I'll split that into company and industry specific points and then maybe some macro viewpoints. In terms of AI adoption, I think it's at an inflection point, a positive inflection point. We're essentially moving past just the infrastructure build out and onto real world use cases. So I would expect more real world adoption to accelerate in the second half of 2025 and into 2026 when we're talking about real world AI applications. In terms of the data center architecture, I think there's a shift going on there. At the major public clouds, I think GPU installation as a portion of their accelerated compute will reduce as these hyperscalers like Google and Microsoft and Amazon develop their own chips. Google is currently the most advanced in this respect with their TPU chip. And on the most recent generation of those TPU chips, we think the price performance on an equivalent basis from a total cost of ownership viewpoint is in the order of 50% lower than GPU-driven servers. The question that people might say at the lower price is, are they any good? So the answer to that, the proof's in the pudding. These chips fully trained Google's Gemini model, and whereas all other models have essentially been trained on more expensive NVIDIA chips. So they do work as a really good substitute, and we know the capital expenditure has been enormous, and these companies will look to save costs by developing their own chips increasingly going forward. In terms of consumer, I think the CEOs were talking about a stable environment. Look, this is a bit contradictory to the recent stock market moves, but they are commenting on what they've seen to date. So there is qualifications there around increasing policy uncertainty in the US. The market is definitely pricing in that uncertainty to see a forward reduction in consumer activity, which may not have happened just as yet. We're definitely very sympathetic to that scenario when we look at consumer surveys and intentions, but for the time being, despite the stock market moves, the consumer in the US has been reasonably stable. If I look to more macro insights, I'd say that caution is coming through. It's further surveys and it's in the outlooks. In terms of government spending, Elon Musk has presented at this conference the last 4 times that I've been there. He expressed confidence in $1 trillion worth of cuts to the US federal budget from the DOGE program that he's running, the Department of Government Efficiency. And that would take US government spending from roughly $7 trillion to $6 trillion. And this cut is, whilst it's flagged that that's the goal, it's definitely not in market expectations. And such a slowdown in spending, we think, could be a negative short-term catalyst for the US economy. I thought also interesting, he didn't mention Tesla at all. As I said, I've seen him at this conference 4 times in the last 5 years, and the chat was all about Tesla. So I think that insight alone perhaps tells you about his focus at the moment, for anyone who had any doubts on where his focus indeed is at the moment. In terms of CapEx and investment, many CEOs wouldn't comment directly on impact from Trump-related risks such as tariffs, policy uncertainty, regulatory uncertainty specifically, but did make the general observations that we all know are true, which is that uncertainty is indeed bad for investment. Business investment, again, we would think with what's going on over there at the moment is at risk of inflecting negatively. And then lastly, I think, from a macro viewpoint, thinking about inflation, there was a broad CEO expectation that AI is going to be deflationary to their cost base, sort of linked to that first point that I made around inflection in usage, the second half of this year and into 26. They see line of sight to real world applications. Now, be it automating customer service, improving the productivity of their sales reps, or just reducing manufacturing downtime on their machines by incorporating AI into their workflows. So there's plenty of sort of clean use cases there to improve business productivity, but we're looking second half of this year and perhaps more so into 2026.
James, that's an excellent summary, actually. And it sounds like AI was a big focus at the conference, which isn't unexpected. And look, we've had the emergence of DeepSeek, and undoubtedly there will be others. And that has placed some question mark over the monetization of AI investments. So what insights did you glean here?
Yes, Alison, I think, great insights. I saw Sam Altman, the CEO of OpenAI, and Dario Amodeo also, who's the leader of Anthropic. So those two companies, OpenAI is obviously famous for ChatGPT, and with Anthropic, they are two of the three most adopted closed source large language models on the market today, alongside Google's Gemini service. And DeepSeek's, I think, definitely catalyzed a moment here, that's for sure. And Sam Altman was on stage and said that the middle layers, like the large language models that his company produces, won't capture much value from AI, and that value would be captured at the infrastructure level and the application level. He even commented specifically that this was bad for OpenAI. I think that's particularly interesting, as reviewing my notes from last year when I saw him, he said one model would lead all models. And of course, what we've seen is new entrants to the market like DeepSeek, like Grok, show similar performance to the leading model builders themselves. And indeed, a year ago, OpenAI was ahead of the other leaders by a bigger margin. So essentially, DeepSeek is a sign that model commoditization is here, and it's going to mean these model builders like OpenAI and Anthropic focus more on applications, be it for search, for coding, for customer service, scientific research, etc. And they'll be productizing AI applications for those use cases. Google already has various applications and infrastructure, namely Google Cloud, that they can use to monetize their model and subsidize the model itself. So we think with its lower cost of compute via those TPUs, chips that I spoke about earlier, and its ability to cross-sell the model, it would be at a longer term advantage versus those other closed source model builders.
And I guess what's within Google, it has that internal use case, the ability to monetize it internally. That's what makes it stand apart from the others, I think.
Absolutely. It's a full stack company, and the monetization is via improving search. It's improving Gemini. It's selling the solution to Google Cloud customers. We would think on average, if they're selling the solution to Google Cloud customers, they might make $1 of revenue off selling this model and incorporating it into applications, but there might be $4 or $5 of attached revenue from other compute and IT services that would be attached to that.
So given what you've just said and raising those comments from Sam Altman, how is the conversation around AI use cases and adoption evolving? And how are then you thinking about potential AI beneficiaries? Do we see a broadening beyond, well, presumably we do see a broadening beyond just the enablers?
Yeah, look, certainly. I agree with, and it's sort of been our view for a while, that we agree with what Sam Altman said that I just mentioned. Infrastructure, certainly applications, will take the value creation here. And so that's good news from our portfolio viewpoint. I think we're positioned well to benefit from infrastructure, taking value creation via that sort of cross-sell mechanism that I just mentioned with Google Cloud, and also applications. And I see this as taking more incremental value going forward than, say, direct semiconductor exposure. Our tech holdings are focused on that infrastructure layer via the public cloud players, and we have a multitude of companies who benefit at the application layer. Now, these can be software companies that are benefiting at the application layer. So I'll use an example of Salesforce, who, through their effective ownership of customer service data, customer service processes and workflows of their clients, have a distinct advantage in building a better customer service agent for their customers. than a startup that may come through, or even a mature software provider that doesn't have all that historical customer service process and workflow to train a customer specific model to provide better answers. In the difference here between having your customers absolutely delighted from a model with the best possible information versus the chatbot experiences that we've had in the past on customer service, which tend to annoy people, it really has incredible value, and this company is well placed to be the one that offers a solution that delights customers. If we take it to sort of non-software side, I think we've spoken about Capital One in the past, and I think this is a great example of non-software, non-tech companies that we have in the portfolio and that we've tried to look at through multiple lenses, including their technology stack. So Capital One is a US bank. They have a internal technology stack that is fully in the cloud and will enable internal AI application development and adoption materially faster than any of their large bank peers. This adoption will improve their risk models, so reduce losses. It will lower their operating expenditure, so customer service is a large cost for banks. And it will also improve that customer service by having sort of more accurate self-service tools, more functionality on the mobile application, etc. And the flip side of this is obviously, taking it back to the portfolio, is we have low and indirect exposure to companies who may be vulnerable to the squeeze in the middle, be it a direct model builder or certain semiconductor companies that are essentially suppliers to that infrastructure layer and get caught in the middle of the customer and that infrastructure provider.
So it's really, just listening to you there, it's really all about the data, having just large amounts of high quality data and being cloud native. And they're the companies that are going to really be able to, drive the benefits of AI, whether that is, as you called out, increasing productivity or having a better sales proposition. So I think that's something that the market hasn't been talking about yet. And certainly, you've raised some really good points. And you raised the point around the semi-exposure. And look, we all know NVIDIA has hoovered up the lion's share of the AI economics to date. And, you're talking about this shift in value towards infrastructure and application layers. And at the top of the conversation, you also called out a shift towards the hyperscalers developing their own chips. So it sounds like we're also going to see more custom silicon and just a lot less dependence on NVIDIA. Taking that line of thinking through a bit further, does this reduce, well, presumably this does reduce supply constraints and as well lowers the cost of the model?
Yeah, look, absolutely. I think a lot of this is becoming reasonably clear when you speak to the companies themselves and work out what their strategies are on custom silicon. I think if you just look at the buying pattern for these models, a lot of corporate customers will buy compute, but that semi-compute capacity in an AI world. They'll buy it via an API, which is essentially a data feed of the model. So you'll plug into a data feed of ChatGPT or Gemini or Llama, and then run that on your data or your application workload. And in that world, customers don't care what hardware is being used on the back end. So the financial incentive for Microsoft, for Google, for Amazon, for Oracle to use lower cost silicon at the back end is really high, because we're talking tens of billions of dollars per annum of CapEx, a lot of which has gone to NVIDIA. These companies will reduce their costs. It definitely means more custom silicon. It means lower model cost, which can improve adoption. And so I think it's good for demand. In terms of what you asked about supply constraints, the biggest driver of supply constraints, which obviously it's hard to model because it also increases demand, but is just falling inference costs. So the costs of ChatGPT or Gemini, for example, responding to a query in an equivalent model versus from when ChatGPT first hit in like 2022, they're down 99% like for like. Now, the actual costs aren't down 99% because we're using more compute because of the models are getting better. But it is very deflationary. And I think this, in terms of the improvement in models has been very deflationary on a like for like. The improvement in the silicon is deflationary. And I think this move to custom silicon is also another deflationary factor.
Widening the lens again before we pivot to the consumer, any risks from the tech conference, and not just AI related, but also much more broadly, that you think the market may be underappreciating? And as well as that, what are you watching as you're shaping your exposure to this part of the market?
There's always things that people will underappreciate. I think tech investors, surprisingly didn't seem as focused on the macro. That's a bit concerning. Tech investors can be very focused on macro at these types of events. Certainly in sell-offs in the past, when I've been in, there has been more concern. So usually that's a sign of a lack of panic, and potentially that's a sign of a bottom is not yet in. Certainly, I think there's been more panic since I left, and the market's down a bit. So, but I thought that was quite interesting given the backdrop. And I think in terms of market underappreciation, we've got to be, I've sort of mentioned my views above that we're going to hit an inflection in adoption of AI use cases in the second half of this year and into 2026. The spending to continue and the huge capital spending on these chips, ROI does need to come, and it needs to come reasonably soon, I think, given the amount of capital that's gone in. And so there is some uncertainty on that. I'm positive on what we will see. But certainly to date, real world implementation by 99 out of 100 corporates, they haven't really seen a return on AI. They're not doing anything material. And if we're gonna see that continued capital spending, that needs to change. And it's important not just for the tech sector, right? Obviously, there's flow through here to the energy sector, for example. So power demand growth is expected to continue to accelerate due to the power consumption of AI workloads. Construction of data centers as being the fastest growing area within the construction sector, and there are other flow through effects. So this is something to watch, certainly for the tech sector, but also for the broader market and the broader economy.
Let's spend a couple of minutes talking about the consumer conference, and look, again, great timing given some of the recent weaker business and consumer survey data that's come out. And you mentioned this earlier, but we've got this backdrop of policy uncertainty around tariffs and immigration, and how this can impact business investment and also the labour market. What did you observe in your week meeting companies?
On the consumer side, tariffs and Trump, more broadly, it just creates uncertainty. And so it's going to be a nervous time, I think, in the space, sort of waiting to see how consumers react to that uncertainty, how they react to the wealth effect of recent share price falls. So as I mentioned earlier, generally, and there are some exceptions, companies are suggesting that the consumer is relatively stable in the US, but the outlook from these surveys is definitely negative. Any inflections that come in the near term, you would expect to be negative. So it's going to be about whether those surveys hit the data, whether they translate, whether they're accurate, or it's just noise effectively. And at the moment, I think that's sort of the $1 million question.
Yeah, the jury's out still, isn't it?
Yep.
Yeah. And what about consumer trends? Like, what consumer trends did you pick up on?
Sure. I think, look, in retail, for example, it's all about platformization. Big and broad in retail will continue to do better. These companies have access to more data on their customers. They're improving their services and investing more to do so. We would say, this is probably priced into the multiples of, a lot of those types of companies. In terms of an exciting new trend, I think retail media is the most exciting new trend in consumers. So retail media is industry jargon for a sponsored ad listing on an e-commerce website. It'll be a huge driver for retailers going forward and retailer profitability. What's a sponsored listing on an e-commerce website? The analogy is Google, and think about Google search results. You're looking for something on Google, you might get 3 ads and 10 non-ad based listings. The same on Amazon. You'll notice that they're quite progressed on this. You'll search for a product on Amazon and you'll get some organic results and you'll get some sponsored advertising results. What's about to happen is Amazon and Walmart have internalized software to offer these services. And smaller players, even really large companies, probably don't have the expertise or the scale necessarily to do it themselves. So we think here we own a company that is the largest provider of a retail media ad network and all the software that companies need to run one of these networks. The company is called Criteo. I think it's an undiscovered gem. Trades on 9 times this year's earnings, despite this being a sector that can grow 25% plus for the foreseeable future. And it supplies that core enabling software to offer retail media to your suppliers who may want to pay for promotion to become higher in the search results to 200 odd large retailers who are trying to compete with Walmart and compete with Amazon and monetize their listings and earn incremental high margin revenue in, the retail sector is a low margin sector. So it's a 5% margin sector and you can get 5% of your sales out of these ads. Very attractive to profitability. So it's a real focus for all these retailers. And so to give you an idea about where Criteo sits, in the US, Walmart and Amazon internalize, but it's that next tier of retailer. Still extremely large companies that use Criteo. So Target, Costco, Best Buy, they all use the Criteo product for their retail media ad networks. In Australia, Criteo powers Coles 360, which is their sponsored listing program. Dan Murphy's, David Jones, Chemist Warehouse. This retail ad network from Criteo has established itself as a leading network for large retailers all around the world to compete with the big guys on sponsored listings, aggregate into one buying center to give scale to and breadth to advertisers. And we think it's a great story going forward in a really interesting industry trend.
And James, just before we wrap up, given we have sort of spoken about this backdrop of uncertainty and, in times like that, consumer staples typically get a bit. But the valuations of this cohort are already pretty punchy. You've got McDonald's on 25 times earnings, Walmart on 30 times, Costco on almost 50 times. And the growth profile for most of these business is more of that mid-single digit style growth profile. In this environment, do you think consumer staples, will still be a hiding place for investors despite, the starting multiples?
Yeah, look, absolutely they can be. From an underlying business perspective, they will be more defensive businesses. The spend on McDonald's can be expected to increase during a recession where eating out becomes less affordable. And McDonald's is an affordable option that's done well in prior recessions. And people will eat out generally, in less in general. So people will go to the supermarket more, which benefits Walmart and Costco. So these are companies that do well in a recession, but it's sort of thinking about longer term expected returns and the longer term opportunity and putting that up against alternatives. So if I don't think too long term, if I just think about 2026 earnings and where we expect those to be, would you like to own Microsoft on currently 24 times our 2026 estimate of earnings? Or would you think McDonald's is better value on 23 times? Now, the growth differential over the last decade has been double digit, and I expect there'd continue to be a growth differential going forward. On retailers, would you rather own Walmart on 29 times 2026 earnings, Costco on 45 times, or Amazon on 26 times? 3 turns lower than Walmart and nearly 20 turns lower than Costco. Again, despite superior growth through the medium term. Yes, more of what is purchased on on Amazon is discretionary compared to more staple type purchases. You might get it at a Walmart or a Costco, but the company's taking so much share. It's hard, even in the most recessionary environment, to see this company grow more slowly than those other names, and it's on a lower multiple. It's got this great cloud business, this great culture. You're seeing, to answer your question about staples, particularly really large mega cap ones like the ones you just mentioned. From an underlying business perspective, they'll be very defensive. But when we think out about earning really high quality defensive returns over the medium term, I think there's better opportunities.
Those comparisons are actually really incredibly interesting.
They are, aren't they?
They really are. James, wonderful to have you back on. It's always great to hear your thoughts, and thanks for taking the time to share your insights from your travels.
Great, thanks, Alison.
The content in this podcast is general information only. It is not advice of any kind and doesn't take into account your personal financial situation, objectives, or needs. You should seek professional advice before making any financial decisions. Stock commentary is illustrative only and not a recommendation to buy, hold, or sell any security.